As we just saw, shares drifting downward today. There's disappointment apparently south of the border that some officials at the Fed don't seem keen to cut interest rates rapidly. There is the US bond yield. It has moved up sharply over the past few weeks. That can happen when investors are apprehensive about inflation, but also, of course, the American government has this big debt load, like a lot of other governments around the world. Here in Canada, the Bank of Canada is due to announce its own rate decision tomorrow. The market is expecting a cut of 0.5 percentage point. Let's get more from Ramona Persaud, who is portfolio manager at Fidelity Investments. It's great to see you.
Thank you.
So you specialize in value stocks in the US and globally. So obviously the income they produce is a big part of that equation.
That's right.
So you're keenly focused on bond yields and interest rates, among other things.
As much as I should be, which is not too much because these are exogenous variables that you can't predict. So what I'm actually keenly focused on is valuation of stocks.
That's interesting. But just to get interest rates out of the way, though, what is your feeling about the Bank of Canada tomorrow? Will they go for a big cut, do you think, 0.5 percentage point?
I think these things are really unpredictable. And I think it's in that unpredictability and the volatility that comes with that unpredictability that you can get stocks that get mispriced and then add them to your portfolio when they're mispriced. So in terms of interest rates, back to your question, you can probably say that the direction of travel globally, and some people are calling this coordinated, the direction of travel is down. So the market today is reflecting, the market in the US is reflecting disappointment over the Fed language or rhetoric about slowing down the pace of interest rate cuts. But if I'm a long-term investor and I step back, direction of travel is down, and maybe I can use that volatility to find some stocks that are experiencing some volatility on the back of that disappointment.
So you have some ideas for us here. You do favor small caps and mid caps, or you say there's lots of opportunities there. And global ex-US is catching your eye right now.
So what's happened in the last, say, 2 years that we've had a lot of enthusiasm over what's called the Magnificent Seven, or I call them the glamour stocks. And that was partly because the rest of the economy was just not growing as quickly as these stocks, the very big high-flying tech stocks, you ended up with a lot of concentration in the market, as we know. And what's happened then is valuation differences between those stocks and everything else just widened a lot. So it was sort of a coiled spring for that valuation difference to close or to narrow. And that's what we've seen in the last, say, 3 months or since mid-July, when the market started anticipating monetary easing. So we've seen what everyone's calling a broadening out. And that's because, at least for a valuation-centered person, the valuation difference between smaller companies, so not anything but the glamour stocks, was just so wide that it was a setup, a coiled spring for a reversion. So what that means is there's just more valuation opportunity in what we call SMID cap stocks. So SMID, small and mid cap, anything that's not sort of large glamour stocks. And so the way that I approach investing is I'm always looking at differences in valuation. And so the sort of dispersion, which is what we call it, or valuation spreads, that dispersion is good ex-US, it's good in cyclicals, and it's good in SMID cap.
SMID cap.
That's where I've been hunting.
That's a new word. I've only heard it over the past few weeks. In terms of sectors, financials, energy, and consumer discretionary look attractive, generally speaking.
Right, and so that's where those valuation differences versus the rest of the market are widest. So inside financials, you can find the widest differences in valuation, inside consumer discretionary and inside energy. So I look at those differences to figure out where I should go hunting. US banks usually lead the earnings cycle. So the banks started reporting a couple of weeks ago. The banks have led, probably accounting for 80% of earnings surprises. So you have this combination of okay fundamentals so far, as we see in the earnings report, plus good enough valuation in the US and definitely outside of the US. as an example of financials.
And when you say U.S. banks lead, are they sometimes a predictor for the earnings
Oh,
generally?
no. They just report first.
Oh, I see.
They
oh,
report
yeah.
first. So they sort of set the tone because they're so economically sensitive. So they set the tone for earnings, which is we're sort of in earnings season right now.
Right, but they're not necessarily predictive of how the earnings will be.
Not necessarily.
Okay. Now, you have some asset allocation ideas here. Overweight quality, value, and dividend yield. I mean, be active in your dividend yield strategy. What does that mean?
So not really asset allocation. The nature of my funds are such that I like to produce excess return, which is what everybody likes to do, but I also want to do that in a very volatility sensitive way. So I care a lot about downside protection. And then I also like to add some excess yield to that. So in order to get those three outcomes, excess return, downside protection, and yield, I will tend to own a lot of quality companies. I will be overweight value to get that alpha. Quality is what gets me downside protection, and I'll be overweight yield to get yield. And so then what that means when you're investing for dividends, you have to be really careful. So if you invest passively for dividends, the best example, the most visceral example I can give you is going into the financial crisis. All of these sort of dividend funds were super overweighted in financials. Like 40% of those funds were financials because that's where the dividends were coming from at that point in the market. And we saw in that huge drawdown, that sector really suffer, and so it crushed those dividend funds. So dividend investing specifically has to take an active approach because the drawdowns from dividends are extremely sharp in a market drawdown.
Well, you draw down, of course, being a euphemism for a drop in the market.
That's right.
Yeah, sorry,
That's right.
go on. Yeah.
So you get a lot of a ton of what we call downside capture, or high dividend funds tend to come with a lot of volatility. And so if you're trying to invest for downside protection, you just have to add enough quality and enough stock picking to your dividend investing, which is how I try to do it.
That's interesting. High dividend investing can expose you to volatility if you're not careful.
Yes, and so taking an active approach gets you really strong risk-adjusted returns in this strategy.
Ramona, thank you very much.
Thank you.